We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Richard Duncan, author of 4 books, including his newest entitled The Money Revolution. He's also a macroeconomist and founder of the video newsletter Macro Watch. Richard, how are you today? Thanks for joining me.
Hi, Tom. Great. Thanks. Thanks for having me back on.
It's great to have you back, Richard. And it's at a very kind of pivotal and actually consequential time. You know, the last time I think you and I spoke was almost 2.5 years ago now, which again, always blows my mind when it's that long between interviews, because sometimes it does feel like just yesterday. And I do want to kind of start this interview by saying that I want the people listening to this to have an open mind to these ideas. You know, I do my best to really try to challenge some of the ideas that are in this space and at least try to, with an open mind, think about things from several different points of view. You know, you introduced a lot of ideas in the book, The Money Revolution, that you and I covered last time. You introduced a lot of ideas that seem very counterintuitive and very, you know, a lot of us, let's say in the Austrian economics area, would have a very negative knee-jerk reaction to. But, you know, with much of the economy being driven by credit creation now, this is something that maybe we have to try to account for, or try to at least be able to wrap our minds around from a different point of view. So with that being said, I totally understand, you know, some of these ideas are going to catch a lot of people off guard. But Richard, if you wouldn't mind, why don't we start by going over, doing a little bit of an overview for those that don't remember or didn't listen to that particular podcast. Give us a little bit of an overview on your book and some of the ideas that you presented in.
Okay, I would encourage your listeners to go back and listen to that interview I did yesterday. It was very, very good. And I thought we covered a lot of very important things at the time that I'm sure we won't have time this time to go through completely again. Mm-hmm. But the book is called The Money Revolution, How to Finance the Next American Century. As you said, this was my 4th book. My first book came out, I think, 22 years ago. It was called The Dollar Crisis. And at that time, the dollar crisis was, I would say I considered myself an Austrian economist as well, or at least greatly influenced by that school. Mm-hmm. And the dollar crisis, I believe, really very accurately forecast the economic crisis of 2008. And it saw the crisis coming and explained the causes for that crisis. And when that crisis occurred in that book, I expected, you know, quite a disaster. What I didn't foresee was the policy response. We had trillions of dollars of fiscal stimulus over the next few years after 2008. But the most shocking thing and most surprising thing was the Fed expanded the size of its balance sheet by about 5 times. It created $3.5 trillion between the end of 2008 and 2014. And it used that money to buy US government bonds to finance that stimulus. And that stimulus prevented the US from collapsing into the Great Depression that I feared and had anticipated and warned about in my Dollar Crisis book, which was based on all of the assumptions inherent to Austrian economic theory. So the thing that I didn't foresee, and I think very few people, if anyone, did, was the Fed would come out with his cannons blazing and get away with it without causing high rates of inflation. The highest rate of inflation we had after that period, despite all of this fiscal stimulus and this monetary stimulus, the inflation rate peaked, the CPI peaked at 3.8% in 2011. And by 2015, it was actually negative again. Now, the reason that the CPI dipped into negative territory in the early months of 2015 again, despite all of the stimulus, and the reason for that is, I can understand quite clearly, is globalization. Almost all of my career has been spent in Asia. I started off my career as a securities analyst in Hong Kong, doing research on the Hong Kong stocks. And over time, I gradually evolved into being an economist and a strategist. And eventually, I became the head of global investment strategy for ABN AMRO Asset Management in London, looking at all the asset classes globally. And over this time, I believe I have developed into an economic historian. And so in the money revolution, it begins, the first part is a history of the Fed, starting at the beginning, 1913, 1914, and how the Fed has evolved over the last 110 years or so. And the main thing that changed during that history was in 1968, Congress changed the law so that the Fed no longer had to back the money it created with gold. And 3 years later, Nixon ended the Bretton Woods system, which required the US to allow other countries to exchange the dollars they accumulated into US gold. So 68 to 71, that was the final severance between dollars and gold. And afterwards, I believe this fundamentally changed the nature of our economic system. So our economic system, the previous system, and all of the economic theory that described the previous system was based on the cornerstone assumption that money was gold. And when money was gold, there were certain constraints that constrained how the economy could function. For instance, obviously, the Fed couldn't print limitless amounts of money because it didn't have limitless amounts of gold. So the Fed was constrained in how much money it could create. And this constrained how much money the government could borrow, because it's a whole lot easier for it's a whole lot easier for the US government to borrow a lot of money if the Fed can print a lot of money and buy those bonds and finance the government borrowing. So the Fed was constrained, government borrowing was constrained, and while we were on a gold standard. And also, very importantly, when gold was money, trade between nations had to balance. It's very easy to understand why. If the US had a very big trade deficit with the rest of the world, it would have to pay for that trade deficit by shipping its gold to the trade surplus countries. And since gold was money, the US money supply would drop in line with its trade deficit. And pretty soon, if this went on long enough, the US wouldn't have any gold left whatsoever. But once we broke the link between dollars and gold, it didn't take the United States very long to discover that it could start running enormously large trade deficits with other countries, and it didn't have to pay with gold anymore. It could just pay with paper dollars, or more precisely, normally, treasury bonds denominated in paper dollars. So suddenly the US started running these massive trade deficits. By the middle of the 1980s, it was 3.5% of GDP, the trade deficit. And by 2006, it was 6% of GDP. The trade deficit was $800 billion that year. And last year, it was about $1 trillion. So the significance of this is once the United States would start able to buy such huge amounts of goods from other countries, we could buy things from other countries with very low-cost labor, like China or Vietnam or Bangladesh or India. And this was extremely disinflationary. It put downward pressure on the cost of goods, and it also put downward pressure on US wages in the United States. And so this brought about a new environment where in the early 80s, our inflation rate had been in the double digits, and interest rates consequently were in the double digits. But as globalization took hold and disinflation drove down the inflation rate in the United States, inflation went lower and lower and lower, and the interest rates therefore could go lower and lower and lower. And this seemed to be despite the fact that the government was running larger and larger budget deficits, which in the past would have overstimulated the economy. Back in the gold standard era, if the US government spent too much money, then it would overstimulate and overheat the US economy because we had a closed domestic economy. There were only so many Americans, so many American workers, only so many American steel factories, and only so many American automobile factories. If the government overstimulated the economy, pretty soon all of these factories would be working at full capacity. Every American would have a job, and there would be a lot of upward pressure on wages and prices, and it would create a wage push inflation spiral. That's the way things worked in the 1960s, when we started getting higher rates of inflation due to too much government spending, and in the early 1970s. But once we shifted to globalization, we no longer had this closed domestic economy with a limited number of American workers. Suddenly, we could buy from the whole world, and the population of the world is about 25 times larger than the population of the United States, and most of these people earn drastically less than the Americans do. So this created a completely new economic environment in which we were no longer, the Fed was no longer constrained in the amount of money it could create. The government was no longer constrained in the amount of debt it could issue. And we could do both of these on a much larger scale without creating high rates of inflation. In fact, during most of this century, up until COVID, the Fed was challenged to hit its 2% inflation target. Inflation tended to be below the Fed's 2% inflation target instead of over the Fed's 2% inflation target. So this created a very different economic environment. So when the crisis blew up in 2007 and 2008, and we got this massive policy response involving $3.5 trillion of new money creation by the Fed, and that still didn't cause inflation, then I thought, okay, all right, we need to learn from this new economic environment we're in. This isn't the old environment where paper money printing leads to high rates of inflation. The sort of environment that Ludwig von Mises analyzed so well back in 1912 and earlier on when we were on a gold standard. This is not the era of the gold standard. We're now in a new environment. And in this new environment, as the period 2009, 10, 11, 12, 13, 14 demonstrated, the government could spend trillions of dollars and the Fed could create trillions of dollars without creating high rates of inflation.
Richard, should we be, sorry to interrupt, but
yeah.
Should we be more specific when we're talking about, that era and the type of inflation that they're creating? I mean, some would argue that they created massive asset inflation, yet not having that inflation or that money creation reflected in CPI type inflation. So should we maybe be, very specifically talking about the type of inflation that they created at that time?
Well, you're absolutely right. I mean, we should be specific if we're going to drill down to that level. Mm-hmm. Most people, when they think of inflation, though, they're thinking of CPI inflation, right? Okay. But you are right. It did create a lot of wealth creation. It did create a surge in wealth. And that was part of the plan. They wanted to create wealth because that helped boost consumption and that helped boost economic growth. And that did lead to increasing income inequality, which is, in my view, a negative side effect. But the alternative to their policy response was a replay of the Great Depression of the 1930s. There was a big credit bubble all during the 1920s. In 1930, that credit couldn't be repaid. The banks started going bankrupt, and the government didn't know what to do. I mean, they all believed in laissez-faire economics, as all the civilized leaders of this civilized world did. And they were taught that market forces should just, sort this out. So they more or less stepped back in 1930 and just let market forces play out. And that's what happened. Market forces played out. A third of all the banks failed. That caused the economy to contract by about 45% if you don't adjust for deflation. It caused the unemployment rate to go up to 25%. And it caused global trade to collapse, leading to crises around the world and the rise of Nazism in Europe in Germany, the conquest of Europe by the Nazis, the conquest of Asia by the fascist Japanese, and then to World War II. And that depression didn't end until World War II started. And only then did the government abandon its laissez-faire policies of balanced budgets and no money printing. And they started having extraordinarily large budget deficits to fight the war. And they started financing those budget deficits with money creation. And we won the war. But government debt, of course, exploded. And after the war, the government had created so much money and so much government debt and so much stimulus during the war that created a boom in the US that lasted through the 1950s and well into the 1960s. So our alternative in 2008 was, okay, are we going to follow the laissez-faire approach that many hardcore Austrian economists recommended in 2008, which would undoubtedly have led to a replay of the Great Depression? So rather than living in a prosperous world since 2008, we would have probably be living through another Great Depression and possibly World War III, if the last time was any example. So the alternative of having massive government stimulus, fiscal stimulus, financed with money creation by the Fed, turned out to be such a better policy response, even if it did lead to increasing income inequality because of the surge in wealth. Now, if people are really concerned about income inequality, the solution is not to allow wealth to grow. We want wealth to grow, right? If you're worried about it being unevenly distributed, then there's a very clear solution to that. Just vote for politicians who are on board with increasing taxes on the wealthiest people. Create a billionaire's tax. Make people pay capital gains taxes after they start earning $100 million a year. There are tax solutions to income inequality if that's what really bothers you. But we want the wealth to grow. If you're worried about how it's distributed, then let's just redistribute it. But let's make the wealth keep growing. Let's not have the wealth collapse and the economy collapse.
So, Richard, as you're kind of walking me through this, and you mentioned that era after the Depression and then going into World War II, obviously the government spent a lot of, or maybe not spent a lot of money, but created a lot of currency going into that era to finance the war, to build those industries, to make all the arms, to support all of those allied forces. Is that almost akin to the idea and the era that we're now entering? And this is kind of somewhat analogous to the ideas of that you presented in the book, to be able to, in a lot of ways, spend to be able to grow our way out of the current situation, or to finance this next century, as you put it.
Right. So the objective of that book was to persuade the American public and U.S. policymakers that the United States now could and must carry out a very large-scale government-financed investment in the industries and technologies of the future, investing in things like artificial intelligence, developing fusion, quantum computing, biotech, nanotech, genetic engineering, and all of the industries of the future. That was the theme. And the way I got there was, okay, as I was saying a bit earlier, after 2008, if the government can double its debt between 2007 and 2014, and the Fed can increase its balance sheet by 5 times by creating $3.5 trillion and no inflation, then, hey, let's do a little bit more of that and have the government finance a multi-trillion-dollar investment in these industries of the future over the next decade. Now, I also wrote that perhaps the best way to structure this sort of investment would be for the government to raise the money, but then enter into joint venture projects, joint venture companies with the private sector, with the most promising American entrepreneurs, the most promising American scientists, with the government funding these investments and keeping a 60% equity stake in these joint venture companies, and allowing the entrepreneurs and scientists who are actually doing the work to manage the companies and keep a 40% equity stake. That was what I suggested. So that once these investments actually begin paying off, if you invest on a large enough scale, we have the potential to create economic or technological miracles. And so if the government were to finance a multi-trillion-dollar investment over the next decade in these industries, we would probably be able to cure all the diseases, create cancer vaccines, develop cheap fusion. And once you have fusion and essentially limitless free energy or very low cost energy, that solves most of the world's problems right there. You can desalinate all of the salt water and provide water for everyone. 2.5 years ago when we spoke, AGI looked like it was still 20 years away. But I warned that we were already in an AI arms race with China. Whoever develops AGI first will essentially rule the world. And so it's very important that the United States get there first, because China is overtaking the United States in terms of their investments in new industries and technologies. And that poses a very grave national security threat. So for all of these reasons, I wrote this book, because it appeared to me that it was possible for the US to carry this out on a very large scale over the next decade, without experiencing high rates of inflation. And then COVID hit, just about the time my book was ready to go to the printer. And the COVID experience was quite different from the 2008 experience. First of all, the government had the option. They had two previous experiences to go by. They could follow the 1930 playbook of laissez-faire and economic collapse and geopolitical chaos and war of the 1930s, or they could follow the 2008 playbook that prevented even a serious recession. Really, it prevented all the banks from failing, and the economy grew, and everyone prospered, and everything was much better in 2019 than it had been in 2009. So that was their choice. Which way do you want to go? So of course they followed the 2008 playbook again, and this time they did it even more aggressively. When COVID started, it really started becoming a serious, very serious concern in the early months of 2020. In March of 2020, the U.S. government debt in the second quarter of 2020, U.S. government debt increased by $2.8 trillion in 3 months. And the Fed created in February, March, and April, basically the same 3 months, the Fed created $2.9 trillion in just 3 months. So we're talking about a multi-trillion-dollar fiscal and monetary stimulus explosion in a 90-day period. I wasn't advocating that to occur on a 90-day period. I'd like to have seen that over a 10-year period. And if over a 10-year period, that sort of investment could be easily digested without causing high rates of inflation. So not only did you get this massive fiscal and monetary response in the early months of COVID, but on top of that, everyone was locked down at home. They couldn't go out and spend money on services. So they all started taking their stimulus checks, which were quite generous, and buying iPads and iPhones and jogging machines. almost all of which were made in Asia. But Asia was also locked down. The factories weren't producing, the shipping lines weren't shipping, and so there were extreme supply chain bottlenecks. So you had this surge in demand caused by the stimulus checks, and everyone suddenly spending on goods rather than services in America, at the same time that you had also these extreme supply chain disruptions. So demand was strong, supply was very disrupted and lower than it had been before. And that resulted in the higher rates of inflation. And just when it looked like that wave of inflation was about to abate, Russia invaded Ukraine in February of 2022, just before we spoke, a few months before we spoke last time. And that caused another round of inflation in food, in metals, and which was another blow. So between that, there were two. So those were two severe blows to globalization. Globalization was the reason that we'd been able to avoid high rates of inflation since the mid-1980s. And suddenly, globalization got two very hard smacks to the face within a year and a half. And that constrained supply, combined with the increased demand that was funded by US stimulus checks, led to the high rates of inflation. So inflation peaked at CPI peaked at about 9.1% in the first half of, I think, 2022. But, and it lasted, caught people by surprise. It caught me by surprise. I certainly didn't think inflation would ever go that high again. But globalization was set back so hard that it did. But now it's gone. It was high for a couple of years, but now it's back to 2.5%. So, there was a big debate about, is inflation transitory or is it not transitory? Well, it was transitory over 3 years rather than over 1 year. So we're now back to 2.5% inflation, which is roughly in line, a little bit more or less in line where it has been for the last 30 years. Mm-hmm. So and since 2019, at the end of from 2019 until now, US government debt has doubled from $18 trillion to $35 trillion. And the Fed's balance sheet during the initial phase of COVID, it went from about $4 trillion to $9 trillion. So the Fed created $5 trillion in basically 2 years or less. And the worst that we experienced as a result of that was we had a temporary spike in inflation to 9%, which was uncomfortable. But we didn't collapse into a 1930s style depression, despite everyone being locked in at home. Because obviously, with people locked in at home and unable to work, without government support, it wouldn't have taken long before these people all started having no income. These people would have started defaulting on their mortgages, their car loans, their credit card bills, all of them, almost all of them. So there's no way the banking system could have survived. All of the banks would have failed, and it would have been a replay of the 1930s. Mm-hmm. Only the stimulus prevented that. So here we are now. Here we are. The economy is significantly larger than it was before COVID started, and the unemployment rate last year was at a 50-year low of, what was it, 3.3%, 3.4%. Now it's moved up to 4.2%, which is still very low, among the lowest levels of the last 60 years. And the economy is really quite strong, despite the Fed having hiked interest rates very quickly and very substantially, and despite the fact that the Fed has been destroying money through quantitative tightening now for some time. The Fed's the total assets, which represents how much money the Fed has created, that peaked at $9 trillion, But since the peak a few years ago, because the Fed is destroying money now through quantitative tightening, it's down to $7 trillion, 7.1 trillion. So the Fed has destroyed nearly $2 trillion, and still the economy is strong. The first half of the year, the GDP growth was really considerably above what's viewed as trend growth. And so here we are. We survived. We have higher debt. We had a temporary unpleasant spike in inflation, and we had a massive creation of wealth. Wealth exploded on the back of this government debt and paper money creation. Suddenly, we had $3 trillion companies, and the stock market has skyrocketed. If you look at household sector net worth, I believe it's shot up to $160 trillion, which is, I've forgotten the exact percentage change, but it's something like, let's say 50% higher than it was in 2009. In 2019. So just since 2019, the net wealth of the Americans has increased by at least 40% to 160. The increase has been, I remember now, the increase has been $40 trillion and since 2019. And why that's significant is $40 trillion is enough money to pay off the entire US national debt with $5 trillion left over. Wow. So the increase in wealth has been so enormous that we could pay off the entire national debt. Of course, if you tax all that wealth, which of course is not a reasonable thing to do, but just to put that into perspective. So Richard, that's where we stand now.
What do you think is the cause of all the inflation that we saw since 2019? For, let's say, between the beginning of 2021 and, let's just say for the last 3 years, we saw money creation at a level obviously not necessarily really seen before in that short of a time span. But is it because of the monetary, not only fiscal, but also monetary component of that direct injection of capital to the American people?
Right. So it was a unique situation. So it was both the US government borrowing so much money and sending it directly to the American households in terms of the stimulus checks. What were the total payments? I think most people received $2,400, not at once, but over the 3 checks, maybe two or three checks. $2,400 was a whole lot of money for a lot of people, and they spent it on things like iPads, like I said, or computers, or whatever they needed to spend it on. And that created a lot of demand, and that fueled, of course, prices are determined by supply and demand. And when the demand goes up, prices, all of the things remaining unchanged, prices will go up. But at the same time, things were made much worse because the supply went down, because we couldn't get these goods from Asia because of the supply chain bottlenecks. And then there was the war in Ukraine, which also disrupted the supply of things like wheat and other agricultural products and metals and minerals, which also, so it was a disruption. I think personally, I would attribute about 2/3 of the inflation to the supply chain shocks, and 1/3 of the inflation to the boost in demand provided by the government stimulus checks that allowed Americans to buy a lot more than they could have done otherwise.
So do you think there are still any other lingering effects from the stimulus over this post-COVID time, or has that, have we kind of captured that in the inflation talk?
Well, so it's interesting, the Fed has did increase interest rates really very sharply from 0% to, let's say, 5.25%.
Yep.
Up until yesterday. in a short space of time. And really, the purpose of doing that was to make the economy much slower and basically to throw people out of work so that wages would go down and inflation would go down. But none of that happened. They didn't slow the economy down. The economy's still been growing at a surprising pace. Average hourly earnings are still rising, at a slower pace, but most recently at 3.8% relative to a year earlier, which is now above the inflation rate. So the workers are benefiting now. Their wages are going up much more than the inflation is going up now. And so the Fed didn't slow down the demand. What changed is the global supply chains got worked out. The supply improved radically. And with increasing supply, then the inflation came down. For example, they break down the inflation numbers into a number of different components, like housing inflation and core services inflation and core goods inflation. Well, core goods inflation, that's normally what we think of in terms of automobiles or computers or washing machines, goods. Core goods inflation is actually negative again. We have core goods deflation. Goods prices are deflating again, as they did during most of this century because of globalization. So we've moved back to globalization is now working again, is very deflationary, and we're back to there. Housing services inflation is still elevated, but expected to come down. And the other parts of services inflation are also expected to slow because the labor market is cooling down, although it's still quite strong. Jobs are still being created. But so the lingering effects of this stimulus that we've seen are still having an important impact on the economy, I believe. For instance, when the government borrowed so much money after COVID started and sent out the stimulus checks, people took those stimulus checks, of course, and deposited them in their banks. So if you look at total bank deposits, they go up in a steady line, very, very steady line going back decades and decades until 2020. And in 24 months, 2020, 21, 22, deposits suddenly surged 35%. There'd never been a jump like this ever. Mm-hmm. And these deposits are still there, and they're still funding this economic growth. And I think that's the main. So this stimulus was almost as large as if the United States had been in a war. Not a world war, perhaps, but a very big war. When the government goes into a war and borrows and spends a lot of money, it stimulates the economy. And this sort of stimulus that we saw during COVID was on a warlike scale. And that has continued to stimulate the economy up until today and is likely to carry on stimulating the economy. Almost all the economists, including me, thought there would be a recession last year. But there wasn't. There was quite strong economic growth that's still carried on into this year, despite the Fed increasing interest rates so much. So we were all wrong. Why were we wrong? I think we were wrong because this enormous stimulus is still powering the economy forward.
Mm-hmm. I think that also speaks to, again, something that we talk about a lot is these long and varied lags that rate hikes and or, in this case, stimulus affect the economy through.
So yes, so it's actually, I think it's worked out very well. And there's been an enormous wealth creation. And the wealth creation has allowed companies like OpenAI to raise money and do things like create GPT-4 and other. All these companies have had easy access to money. And this is resulting in a technological boom of sorts. Mm-hmm. That we haven't seen before. I mean, artificial intelligence is absolutely revolutionary. That wasn't clear the last time we spoke. It was clear that it would be. But what's going on now is just mind-blowing. Mm-hmm. Just, for example, 2 or 3 days ago, I discovered something new that allows me to I make a lot of videos for my business, Macro Watch, discussing what's happening in the economy. And recently, so I always make these videos. First, I create a presentation with a lot of charts and a lot of text, and I save it as a PDF file. This new app or website allows me to upload my PDF file, and within 3 minutes, it turns it into a podcast. This podcast was just blew my mind. It was two people, a man and a woman, having an intelligent, engaging, and even witty conversation about my presentation. And I would say it was 95% correct. There were a couple of mistakes, but it was 95% correct. It was 10 minutes long, and it was brilliant. It was like this new tool that may be very important for my business going forward. I can upload my presentations in the future, and rather having conversations with you and me, I can just let the AI him and AI her discuss this in a more engaging way than, frankly, I can do on my own when I make my presentations. So this is just changing so quickly, and this is just the beginning. Mm-hmm. We're going to see extraordinary technological developments grow out of this. And it does appear that the United States is on the lead in this, but it's so crucial that we continue to be the leader of this, because if whoever wins this AI race is going to rule the world, and we don't want that to be China. And there's a real risk that it could be, because China invests more in new industries and technologies than the United States does. Whereas 20 years ago, the US invested 10 times more than China did in new industries and technologies. Now it's neck and neck, and they're about to overtake us. And that's why they got 5G so long before we did, and why they have hypersonic missiles, and we still don't. Mm-hmm. This is a neck and neck race, and they're overtaking us. So this brings us to what I think is extraordinarily great news over the last couple of weeks. Just about less than 2 weeks ago, both former President Trump and the Biden administration, almost at the same time, they both announced that they are now supporting the establishment of a U.S. sovereign wealth fund. Now, what does that mean? Well, essentially, what it means is they understand that it's very important for the U.S. government to finance investments in new industries and technologies, so that we win this technological arms race and not be surpassed by China effectively. And that is exactly what I was calling for in my book, The Money Revolution: How to Finance the Next American Century. In that book, I explain why it would actually be very easy for the United States to finance a multi-trillion-dollar investment over the next 10 years in cooperation with the private sector. So there's been some reaction to these proposals about the U.S. having a U.S. sovereign wealth fund. Some people have wondered, well, why is it necessary to create a sovereign wealth fund when the U.S. Treasury Department already invests a lot of money in certain technological development? The U.S., for instance, funds DARPA's research, high-tech research, and it funds military research. But the significance of a sovereign wealth fund, what this means is the government would make investments in companies or even in startups, but rather than just in making the investment and letting the private sector keep all the profits, the government makes the investment, but it keeps an equity stake in these companies, so that the profits and the profitability accrue to the US government. In other words, to the American public, the US taxpayers. So for instance, many people over the last 25 years, there's been a growing distrust of the US government, and many people think that the government can't do anything right. I totally disagree with that, but that's the prevailing sentiment, I would say, despite the fact that had things like NASA. We hear a lot about these high-tech companies and their moonshot projects. Well, the original moonshot was NASA sending a man to the moon 50 years ago. That was all U.S. government funded, all U.S. government managed and directed. And also, I always hold up my cell phone when people question whether the government can do anything right. And the reality is almost everything in a cell phone that makes the cell phone intelligent was created as a result of US government funding for basic research. For example, semiconductors, GPS, voice recognition, and of course, the internet itself. Everything in the smartphone that makes it smart all originally came from US government investment in technology. Mm-hmm. So it's wrong for the American people are incorrect if they think that government funding is not important. The problem with our economy, I would argue, is that since the 60s, the US government currently is investing only half as much in research and development as a percentage of GDP as it did in the 1960s and 1970s. Mm-hmm. So there's been a very sharp decline in government funding for basic research relative to the size of the economy. And I think this is one of the reasons that we've had a slowdown in productivity and generally a slowdown in economic growth relative to what we saw in earlier times. So I was so excited to see the Biden administration and former President Trump both announcing that they support the establishment of a U.S. sovereign wealth fund, because this is exactly what we need. This is what our country needs for so many reasons. For one reason, it would be really quite easy for us to finance, and on a very large scale. I mean, there are sovereign wealth funds all around the world. The largest one is Norway's. Norway has $1.7 trillion sovereign wealth fund. And then there's Abu Dhabi, and Singapore has two. And Singapore is very successful that GIC and Temasek have invested and made enormous profits that benefit the people who live in Singapore. And I've lived in Singapore more than once, and this has been a tremendous success. And then the oil countries have sovereign wealth funds. China itself, you could say, is just the entire economy is one giant sovereign wealth fund, because the government controls everything and directs the banks and their lending. Mm-hmm. And they're directing the Chinese banks to lend in the industries and future technologies. You know, they have a plan to dominate all the major industries of the future over the next decade, and they're going to succeed if we don't respond accordingly and invest on a much larger scale than we're currently investing. And it would be so easy for us to do this. And if we do this, then we're going to have the most extraordinary technological breakthroughs. I mean, we really do have the potential over the next 10 years of curing all the diseases and developing fusion, nearly limitless, clean, relatively cheap energy, and just all kinds of new extraordinary technological breakthroughs that would radically improve human well-being and extend life expectancy, long, healthy life expectancy. And by setting these investments up through a sovereign wealth fund, this means that the government will keep the profits coming from this, and these profits then can be used to distribute to the American public, for instance, as dividends or as free fusion-generated energy, or given that the government would earn so much money from these investments will pay for themselves many times over the next 10 to 20 years. And as they do, then tax rates could be reduced, because the income generated from these revolutionary technological breakthroughs would be so large that taxes could be reduced, and even the government debt could be paid down. So this is the way forward. And if that's not persuasive enough, then let me hit you with the national security angle. the U.S. national security is we are at risk of being overtaken by China. This is not a small risk. Russia, the Soviet Union, has never came so close in threatening the United States national security as China does today. If China continues to expand its investments in new industries and technologies at the current rate, then well before this decade, well before the next 10 years passes, they are going to be the undisputed global technological, economic, and therefore military superpower. And the United States is just going to be a has-been, vulnerable, second-rate power at China's mercy. And there's just no reason for us to allow that to happen when we can have the capacity to out-invest China by a very large margin. And that's why I said this is how to finance the next American century. The first American century doesn't have to be the last. America doesn't have to be a declining power. We have the ability, through investing on a very large scale, to reinvigorate the economy and lock in U.S. national security and prosperity for generations to come. And we have to take advantage of this opportunity. And so
Richard,
that's what the sovereign wealth offers the opportunity for us to do. Mm-hmm. So that's, you began by asking your listeners to be open-minded, and they must be suddenly surprised to hear that both parties are now recommending large-scale government-funded investment in new industries and technologies. But this is why. I mean, Congress finally caught on to the idea that we are in danger from China and that we must do this. After we spoke during the last time, you asked me, is your book gaining any political traction? And it had only been out a few months then, and I had to admit, no, not really. But then in August of that year, they passed the Chips and Science Act, which allocated $52 billion for developing semiconductors in the United States, and in total, $280 billion for new investments in new industries and technologies. And so that was a major step forward in the right direction. It was just the scale was way too small. And then the following year, later that year, I was invited by a congressman to come to Washington and present the ideas in my book to members of the House Ways and Means Committee at a policy dinner in Washington in February of 2023. So at that point, it had gained some political traction. And I was delighted to have the opportunity to present the ideas in the book to these congressmen and congresswomen on the House Ways and Means Committee, which is the most powerful committee in Congress. And so I can't tell you how pleased and relieved I was to see these announcements that both parties are now in favor of establishing what I've been calling for, going back for the last 15 years, starting in my second book in 2009.
So, Richard, as we're trying to think about the actual way to implement some of these ideas, let's put a number on it. Let's say $5 to $6 trillion could fund these programs, fund this growth for the next, let's say, at least decade. Obviously, we acknowledge that is a far more digestible timeline in which to issue an amount of debt like that. But who's going to be buying that debt? If the US government issues all of that debt, who's going to buy it, especially if we're looking at China as traditionally having such an appetite for US debt? Going forward, if there's such an enemy, who do we expect to be buying that debt?
Okay, well, so of course, how this is going to all actually work out in practice has to be very carefully thought through by a lot of very smart people, because it is going to be complicated. And we need to get the structure right. But so you spoke of $5 or $6 billion over 10 years. that's really, it sounds like a lot of money, and it is, but you have to keep in mind that the US economy is not going to be the same size now. 10 years ago, it's not going to be the same size 10 years from now as it is now.
Mhm.
It is going to be very much larger. And as the economy grows, households save money. And that household savings increase. And that creates, and pension funds increase. And the pool of national savings available to fund the borrowing increases over time. So, you wouldn't, if I told you in 2019 that the US national debt was going to double from $18 billion to $35 trillion, you would have asked the same thing. Who's going to buy all of that debt? Mm-hmm. But they did buy it. And did the 10-year bond yield skyrocket to 10, 20%? No, the 10-year government bond yield now is about 3.6%. It's not like we're having any funding difficulties. US government debt as a percentage of GDP, gross debt, is about 120%. Japanese government debt as a percentage of Japan's GDP is more than twice as high, 260%. Versus 120% in the US. So Japan's been funding very large amounts of debt for far longer than we have, which illustrates that we can do this also. Now, another source of funding available that will be available to finance US government debt is this. Every year, the US has a very large trade deficit, current account deficit. Roughly $900 billion, $1 trillion this year. And what that means is foreign companies sell their goods in the United States and they get paid in dollars. And they take their dollars back to their own country. But they don't hold those dollars in paper dollars, right? They have to invest those dollars in dollar-denominated assets. And the dollar-denominated asset that they prefer to invest them in is US Treasury bonds. But it doesn't matter what they invest them in. They can buy Fannie bonds. They can buy NVIDIA stock. They can buy, a house in Omaha. Whoever they buy those assets from, they will then have the dollars. And those dollars are going to end up in Treasury bonds, or a lot of those dollars are going to end up in Treasury bonds. So the point is the US current account. And so once those dollars go overseas, since Bretton Woods broke down in 1971, the cumulative US current account deficit has been $15 trillion. So that has thrown $15 trillion off into the global economy. And that has resulted in the rest of the world, owners of those dollars have invested that $15 trillion back into US dollar-denominated assets. That's why the rest of the world owns so many treasury bonds. Now, until recently, China's trade surplus with the United States has been about $400 billion a year. It's a little lower the last year or two. But China gets $400 billion a year. What do they do with it? They don't bury those dollars under the Great Wall and just let them rot. They don't keep them in a big safe somewhere in Beijing. They invest those dollars in US dollar-denominated assets, and that funds the US government's borrowing. So surprisingly, the larger the US current account deficit becomes, the more money there is overseas to finance US government borrowing. Now, this money that's overseas, that cumulative $15 trillion, that's sort of trapped dollar savings. Those dollars are not going to go away unless the US starts running a current account surplus. And then the reverse would occur. The amount of dollars abroad would shrink. Mm-hmm. But the US isn't going to start running a trade surplus anytime that I can foresee under any circumstances. So this current account deficit is going to provide about $900 billion of funding that's going to make it easy for the US to finance increasing government debt or debt in general. Every country's balance of payments has to balance. What that means is the current account deficit has to be matched by inflows on the capital and current account. It's just like a family. In this case, if a family spends more than it earns, it either has to sell something that it owns or it has to borrow the money. And it's the same with other countries. In this case, if they sell us more than we sell them, then we get their products, but they're going to get something in exchange. And what they get in exchange is US debt. And so this is very helpful. This is why having the dollar as international reserve currency is so important. Mm-hmm. And the reason the dollar is the international reserve currency is because the US has such a big current account deficit every year. Initially, it was the international reserve currency because we won World War II. And at the end of the war, we had almost all the world's gold. And so it was the strongest currency. And that's why it started off as the international reserve currency. But now it's the international reserve currency because the other countries have had a $15 trillion current account surplus with us over the last 50 years. And they're going to add another trillion to that over the next 12 months and over the next 12 months after that. And so as long as China wants to keep selling us their goods, which they must do to keep their people employed, then they're going to keep accumulating more and more dollars. And as they do, they're going to have to keep buying more and more treasury bonds or some other dollar-denominated asset. Now, you may be thinking, okay, they've got these dollars, they don't have to, they could buy euros. Okay, they could buy some euros, but whoever they buy the euros from, those people are going to have the dollars, and they're going to have to buy the treasury bonds. So this is very important to understand. One of the great advantages the United States has as a result of being the international reserve currency and the dollar. And that's not going to change anytime in our lifetime. But we have to be aware that if we impose very high trade tariffs on other countries, for example, if we put 200% trade tariffs on Chinese goods and 20% trade tariffs on all of the goods of our trading partners, then our trade deficit will become much less. Mm-hmm. And therefore, the capital inflows coming back into the US will be much less. And it will be much more difficult then for us to finance the government borrowing. So this is just economic analysis of why, one of the reasons why very large trade tariffs would damage the US economy.
You said that the
not opposed to targeted trade tariffs, and I certainly think that we should be applying the screws to China and importing less from China. I think that would be a good idea, but we need to offset that reduction in imports from China with more imports from other countries that are friendlier than China. And that would keep this whole system going to our advantage and China's increasing disadvantage.
Richard, you said that you don't think that the US dollar as a global reserve currency is going to be coming under threat anytime soon. Why is that with the rise of the BRICS as we've seen? And again, if we're looking at China through this lens of being really an enemy of the US and using, if not outright warfare, at very least economic warfare against the US with their group of trading partners, does that not start to threaten the US dollar?
Well, their trading partners are not very powerful. They don't have very large economies. Mm-hmm. Russia's economy is smaller than Canada's economy. And I'm not exactly sure the size of Ethiopia's economy, but it doesn't really register. Yeah. These other countries in there, India is one of the BRICS. India is a political enemy of China. They have their military is facing off in the Himalayas and frequently shoot at each other. They really, really don't like each other. And there is no one to buy. No one is going to have a $400 billion a year trade deficit with China, except the United States. So China desperately needs to sell things to the United States. China has been transformed by its trade surplus with the United States. When I first moved to Hong Kong in 1986, China was a very poor, third world country. Very, very poor. It's unbelievable. And within just a few decades, it has been completely transformed into the second largest economy in the world. That was entirely due to its very large trade surplus with the United States. It had all that trade surplus money that they had from the US went into Chinese banks. So the Chinese banks were able to extend more loans. And through fractional reserve banking, they were able to build the most extraordinary infrastructure. China has far better infrastructure than the United States does. They built millions of high-rise buildings and have created this and invested enormous amounts in developing their military and technological industries. None of that would have been possible if the United States had balanced trade with China. China would still be a very poor developing country in that case. So China can't afford to, they must keep selling things to the US as long as the US is willing to buy them. Because if they don't, then there's no one else in the world to buy China's goods. And China already has too many goods. The world's not big enough to absorb everything China's trying to sell. And so as long as the US is willing to buy their goods, China will definitely be happy to sell them to the United States because they've got to keep their workers employed, or else there's going to be political unrest, severe political unrest. And if they're selling their goods to the US, that means they're getting paid in dollars. And if they're getting paid in dollars, then the dollar standard is under no threat whatsoever. China's not going to reduce its dollar holdings. It's going to keep increasing them in line with its current account deficit, in line with its current account surplus with the US.
Right.
It may diversify a little bit. It may buy some gold. And in fact, that's why it's one of the major reasons, I think the main reason that the gold prices have moved up so much is because other countries' central banks are buying more gold than before. But whoever is selling them the gold, they're getting paid in dollars. And they're going to have dollars that they have to invest in US government bonds or some other US dollar-denominated assets. Those dollars are not going to go away. Somebody can sell their dollars, like a farmer can sell his farmland, but it doesn't make the farmland disappear when you sell it. Someone else owns it. So the dollars circulating around the world are just going to continue to become larger and larger as long as the US has a current account deficit, which seems like it's going to continue as far as I can see in the future. There's no obvious reason why this deficit is going to go away anytime soon.
So, Richard, you mentioned earlier that you got the call of going into recession last year even wrong. We saw today for me, yesterday for you now, the Fed do their first rate cut after this enormous rate hiking cycle. They cut rates by 50 basis points. So what do you expect for the markets? And is it possible that the Fed, because of, I think by some viewing this 50 basis point rate cut as higher than the expected 25 basis point rate cut, do you think that they're reacting to something that is far more troubling to them than they're letting on?
No, I think they made the right decision in cutting 50 basis points because the federal funds rate, it was a range between 5.25% and 5.5%. That's twice as high as the inflation rate. The inflation rate's 2.5% now. So the monetary interest rates at that high are really very restrictive a monetary perspective. There's no reason to have the interest rates so high, given how rapidly the inflation rate has come down, and given that it's very likely that it's going to move back in line with the Fed's 2% inflation target in the near term. So the labor market is beginning to cool. It's still relatively strong. If you look at the monthly jobs numbers, new jobs are still being created every month, but just not as many as before. Normally, if you have any sort of recession, you have a lot of job losses every month, right? Big job losses. We're still creating jobs, but if you drill down, you can clearly see signs that the labor market is cooling. For example, the number of new job openings that are posted every month, they peaked a few years ago at 12 million job openings. They're now down to about 7.5 million job openings. Meanwhile, the number of people employed is unemployed is beginning to tick up some. So a couple of years ago, this ratio between job openings and unemployed people was 2 times. There were 2 jobs available for every unemployed person. Well, now it's down to just 1.1 times. So that's a clear sign that the labor market is cooling off. And the average hourly earnings still quite good at 3.8% year on year. It has come down significantly from 5-point-something% a couple of years ago. And the number of average hourly earnings, the average weekly hours worked was increasing. In other words, people were working more hours. That was increasing in 2021 and 2022, but now it's begun to flatten out. So there are a number of signs that the labor market's cooling off. And now that inflation seems to have been largely, hopefully, beaten, there's just no reason to keep cooling the economy down unnecessarily. There's no reason to provoke a recession if we don't need a recession to cool down the inflation rate. So it makes sense to start cutting the interest rates. The interest rates are too high. I mean, we want the economy to grow. We want people to have jobs. We want the unemployment to be low. We just don't want to have inflation. Mm-hmm. And so it makes a lot of sense for the Fed to begin cutting now. And I was happy that they did cut by 50 basis points. But it's still quite high between, what is it now, between 4.75 and 5.0%.
Mm-hmm. So do you think that these cuts could actually force investors out of the yen carry trade, and that could actually cause an unwind in the markets as well?
That is a real concern, that the lower interest rates will cause a further unwinding of the yen carry trade. So what is the yen carry trade? It's really quite straightforward. People are able to borrow yen in Japan at something very close to 0% interest. And then they take the yen, convert it into dollars, and you could invest in treasury bonds quite recently, earning 4.5%. So you've got a very big gap there, the interest rate differential. And then if you leverage up, if you borrow a lot of money, borrow a lot of debt and do this trade, you can actually earn enormous amounts of money, mm-hmm. as long as the yen doesn't get stronger. And so this carry trade was working brilliantly because the yen was getting weaker and weaker and weaker for years, since 2011, I think. It recently hit a low of 160 something against the dollar, which was very, very low for the yen. But now things changed around August 5th. We had that quite violent sell-off in the markets on that day, because in the prior week, the Bank of Japan unexpectedly increased its interest rates, mm-hmm. a little bit, 25 basis points. And at the same time, we had bad, or what were perceived as being weak employment numbers coming out of the US, which led the market to believe that the Fed would start cutting interest rates more aggressively than they had expected before. So what that means is, projecting out into the future, the gap between US interest rates and Japanese interest rates is going to come down very significantly. And when the interest rate differential comes down, that should cause the yen to strengthen. And in fact, the yen has strengthened from 162 now down to about 142. But even 142 is quite weak relative to the norm. Mm-hmm. I've seen it as low as 80 to the dollar in the past. And as this interest rate differential continues to narrow, as the Fed keeps cutting interest rates over the next year to year and a half, the yen is probably going to strengthen. And what this means is that all the people who have borrowed money to take advantage of the yen carry trade, suddenly they're going to not only have a smaller interest rate differential to benefit from, but they're going to be losing money on the appreciation of the yen because they'll have to pay back. It will cost them more to repay their yen loans as the yen strengthens. So this has the potential. I don't think anyone really knows the size of the yen carry trade. There was a lot of speculation in the press about how large it could be, but I imagine there's more to be unwound there. So that is one of the danger. One of the things that I worry about in terms of how the financial markets could be impacted over the next 6 to 12 months. Mm-hmm. Other thing that worries me is that asset prices in the US really are very inflated relative to their historic norms. Mm-hmm. There is a ratio that I keep track of that I call the wealth to income ratio. What it is actually is household sector net worth. In other words, all the wealth of the households divided by disposable personal income. So it's wealth to income. The average of this wealth to income ratio going back to 1950 has been about 550%. But it got up to 620% in 2000 at the time of the NASDAQ bubble, which was well above the average of 550. Mm-hmm. And then the NASDAQ bubble popped and it went back to its average. And in 2008, it went up to 660, which was by far a new all-time high. And then, of course, the property bubble popped and it went back to its average of 550. Now it's something like, I think, 750. So it's just so much above where it's ever been before that what that's telling us is that there's a real asset prices are stretched relative to people's income. And that is a warning signal that the markets are vulnerable to a correction if anything at all goes wrong. Now, for a long time, people said there was a good justification for asset prices being so high relative to income, because for a long time, interest rates were near zero. But even after the Fed increased the federal funds rate above 5%, these asset prices still remain very inflated relative to income. And so that's something that worries me, that asset prices are inflated relative to income, relative to their historic norm.
Mm-hmm. Yeah, it definitely seems like a possible time of revaluation, especially at very least a reversion of the mean to that long-time average.
Very possibly. I mean, it has reverted the last two bubbles that we had. Mm-hmm. Now, on the other hand, I do think we're still going to continue to have the economy powered further by all of this stimulus that we discussed earlier that came from the government during COVID. That's probably going to keep powering the economy, and lower interest rates. Now, the Fed will start lowering interest rates. That should reduce the credit card cost and make borrowing more affordable, both for consumers and for businesses. And that should help the economy. So there are reasons for optimism, also reasons for concern, as there normally are.
Absolutely. Well, Richard, I think we've certainly covered the gamut today on, many of the ideas that you presented originally in the book. Is there anything that you'd like to leave our listeners to think about or to consider before we wrap up today?
Well, I'd really like to stress the importance of keeping an open mind and understanding why it is so important for the United States to establish a sovereign wealth fund. and to understand how much they would benefit from that, both as individuals and as a nation, as our national security is greatly enhanced. So with both sides now advocating that, the public needs to understand why this is such a good reason and take that on board and believe in it, because it is really going to be very important and beneficial to our future. Mm-hmm. And also, I'd like to encourage your listeners to visit my website, richardduncaneconomics.com. They can follow my work there, richardduncaneconomics.com. As you mentioned, I produce a video newsletter called Macro Watch that I sell on a subscription basis. Every 2 weeks, I publish a new video that's about 20 minutes long, and it has about 40 or 50 charts that they can download. These videos discuss something important happening in the global economy and how that's likely to impact the financial markets and wealth in general. So if they would like to subscribe to that, I would like to offer them a 50% discount. If they hit the subscribe button, they'll be prompted to put in a discount coupon code. If they put in the code value, they can subscribe at a 50% discount. And I think they will all find that very, very affordable. It's not very expensive. And there are 100 hours of videos in the archives, which they can begin watching immediately. And they will receive a new video every couple of weeks.
Mm-hmm. Excellent. Well, we appreciate you sharing that with our listeners, Richard. And of course, that was at richardduncaneconomics.com. And also on Twitter, you're at Paper Money Econ as well, right?
That's right.
Perfect. Richard, thanks so much for your time today. Really appreciate you walking us through these ideas.
I enjoyed our conversation again. Thank you for having me back on.
Absolutely. Look forward to the next time.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.